What's going on, everybody? Welcome back to another week, another wealth webinar. So excited to have you here, but we're even more excited because we've got a legend on with us today. The one, the only, Mr. Garrett Gunderson, the author of many books, but the one we're going to be talking about today, What Would the Rockefellers Do? So we're going to be talking about a lot of things. We're going to be talking about what the wealthy do so that their wealth that they build up in their lifetime isn't squandered one or two generations past them. We're going to talk about the systems that they build, how they do that. We're going to talk about all these things, and we are going to literally have a chance, all of you. We've been doing this webinar now since Sean actually got it right down to the day. Wednesday and September 19th is when this started. And we said, we're going to do a webinar every single week. It's going to be completely free. It's going to be the same exact time. And all we're going to do is we're going to teach people how to take back control of their money by being their own bank. And well, here we are. And as you can see, a lot of folks have been joining us. You know, this is always a super fun event for myself, for the team, and well, now to you. And, you know, I want to talk a lot about what the wealthy do. You know, the wealthy don't just earn money. The wealthy build systems, and those systems allow their wealth to carry on into, you know, future generations. But, you know, there's also some very unique stories we can talk about wealthy families that did not build these systems. Right. Wealthy families that just generation after generation just thought that their wealth was going to be around, and namely the Vanderbilts. And I know you can talk about them, but $250 billion. I want everybody to think about that, $250 billion. I don't think there's one person on this webinar or even one group or all of us combined that could spend $250 billion in our entire lifetime if we tried our hardest to do it. I don't know that to be fact, but I'd have to believe that'd be tough, Garrett. And the Vanderbilts were able to do that in 3 generations. Gone, you know, just wiped out. But the Rockefellers are 6 generations strong, but they had trust, structure, and they had a family bank. And I want to kind of turn this over to you. You know, I know that we were honored to work with you and, you know, do the forward to the book, What Would the Rockefellers Do, folks? And we're going to have this available to all of you today just for joining us on this webinar. But, you know, Garrett, I'm going to kick it over to you. Tell me a little bit about, like, back when you wrote this book, like what motivated you to write a book about the Rockefellers?
It was 2015, and it was between Christmas and New Year's. I was meeting with another guy that, Michael Isom, that, you know, had been getting a lot of leads from my firm. And he said that we hadn't been sending leads over for 4 months, but we had been crushing it. So I was like, that doesn't make sense. So I call our CEO. He's like, yeah, we're just going with another firm. And I was like, well, why don't I write a book about life insurance? And that'll help generate leads for you, Michael. And so I start writing a book about life insurance, and I'm giving a webinar, and this woman, Sheila Brandenburg, is attending the webinar. And she reaches out afterwards saying, I'd like to talk to Garrett because I work for the Rockefeller family office, and what he's talking about is so spot on. And I think we have an interesting conversation because I want to implement what he's talking about. So I get on the phone with her. I said, hey, this is awesome. And, you know, with my long hair back in those days, and it was more black than gray, people would say, you know, I look like Jesus. So it would always be like, what would Jesus do? I was like, what would Garrett do? I was like, well, that's where I got the idea. What would the Rockefellers do? After that conversation with her. And so now I had to rewrite the whole book. Now I had to like start over and start to research like the Rockefellers versus the Vanderbilts, because I remember hearing those stories about the Vanderbilts. But I mean, Cornelius Vanderbilt said, let's keep the money together when he died. And he gave most of it to William Henry, his eldest son, who doubled the estate in 9 years. So he does a really effective job. And then that was the last time the estate grew. It got decimated to the point where 54 years later, the first Vanderbilt dies broke. They own 10 mansions in Manhattan. They own none of them now. They own the Breakers in Rhode Island. That's gone. The Biltmore Estates in Carolinas. I'm going to speak there next month because someone thought it'd be cool to have me speak on the Rockefellers versus the Vanderbilts. So, I mean, like, yeah, they were wealthy socialites. They didn't have a trust. They didn't know how to utilize insurance. They just knew how to spend money. They were, I mean, as you said, it's pretty historically amazing how much money they blew through. Like, that is truly difficult. They were having these like Great Gatsby kind of like parties at mansions and stuff back in the day, and they just totally annihilated that, all of the wealth. Where the Rockefellers, like you said, 6 generations going on to 7. You know, most people, it's shirt sleeves to shirt sleeves, they lose it in 3 generations because they don't capture what you're talking about at the very beginning, the family legacy rings. The family legacy rings combined with the 2 critical components of the Rockefeller method are this. Number 1, life insurance. And not just on your life, but on life of everybody in your family, because the Rockefellers almost looked at the family members like a part of a business. that every time a Rockefeller is born, they're like, that's another asset to this Rockefeller family. And we want to make sure that if anything happens to them or when it does, that it replenishes the trust, because we don't control interest rates or we don't control tax rates or even inflation rates. So they had this way to replenish the trust. And that's been instrumental. But it was also having a trust and saying, hey, I loved how you spelled yours out, Chris. Like, your family isn't just getting money. They can borrow against it. And there's a certain set of values. And there's 4 main things that they could get that money for. And outside of that, it would have to be like, are they starting a business, or is there a way that you're financing it? So like ultimately having a trust where you own nothing but control everything, that was really a Rockefeller methodology, right? And then having the insurance that could replenish the trust from generation to generation. And then there's these 3 peripheral things that really hold this together, which is a family office concept, just having someone that quarterbacks for you, who helps you navigate your entire financial life, whether it's, because let's face it, most people in finance, we've been in this long enough, Chris, to know it's pretty reactive out there in the tax world quite often, or, there's just a lot of missing pieces and holes in people's plans. And ultimately, if you have someone that can help you think through these things and build the team around it, then you're just going to have a lot more sustainable wealth. That's the family office concept. Now, we're not wealthy like the Rockefellers, most of us, so they were wealthy enough they could just hire a financial firm just for their family, hence the term family office. So yeah, if someone's worth $300 million, they could probably afford that. But otherwise, they could listen to a webinar like this. They could work with you. They could figure out like the pieces by having someone that's, a point person on your team. That's critical. That's the family office concept. The second is a family retreat. This is investing in your heirs. Your heirs, if they just get money and nothing else, like I think if they wrote a sequel to The Millionaire Next Door called The Millionaire Next Door's Kids, what we'd find out is all those kids blew that money so damn fast. Because The Millionaire Next Door, the whole phenomenon was they didn't talk about money. They held on to it. They had all this money in the bank account, but they were broke and miserable, never utilizing it or benefiting from it. And now all of a sudden their kids are going to find out, wait, you had a bunch of money? We didn't know because you drove a old beater truck and wore the same clothes. So like they didn't have a family retreat structure. But David Rockefeller, one of my mentors I just had a call with him before this, mentored David Rockefeller. And he said that was pretty fascinating that David didn't even know how wealthy the Rockefeller family was when he was really young, because they weren't living in the main house. And then the students and the other kids at school told him that. And then he got invited to the family retreat. And they would meet every quarter as a family. This is how they would invest in their heirs. So they could say, hey, what are the philosophies? What are the values? What are the signposts? What are the guidances and principles that we want to share that could be indoctrinated to help our family? And then finally, the family constitution, which is a preamble to the trust. Some people have trust that just divide, distribute, destroy. That says, hey, when you're 30, you get this much money. When you're 35, you get this much. And when you're 40, you get this much. And then it's just gone. I mean, who knows what that person's going through at that time in their life? What struggles they might be having, or marital issues or health challenges. And if it's just like, here's a bunch of money that gets dumped on them, well, maybe that destroys their purpose, or that disincentivizes them from doing the things that really matter in their life. And it can be more of a curse than a blessing if it's not intentional. So family constitution says, well, what if we had a set of standards and signposts that were in your own words to say, hey, why did you start this? What do you intend to do with it, so that you leave behind a heritage, not an inheritance? So your name means something, the values get transferred, and hopefully the next generations don't have to make all the same mistakes. So anyway, that's the family legacy rings, the family office, the family retreat, and the family constitution. And then at the core of the Rockefeller method is insurance. And it's, it's just insurance and trust. So if we narrow it down to those 5 things, that encapsulates almost everything that the Rockefellers did. Now, they had more complicated situations. They could do private placement, and they could do premium finance, and they could do stuff that isn't really for everyone. So in the book, I made sure what would make this accessible and available for anyone to start a legacy no matter where they're beginning. Because what my objective is on this planet is to make 1 million people. I want to make sure 1 million people have a lasting legacy. Imagine if a million families can change their family's financial future and their destiny, and we can just narrow it down to what are the most predictable, stable things that raise the stakes in the most positive way and stack the odds in the favor of it succeeding. What I mean by raising the stakes in a positive way, Chris, you know how many people just raise the white flag with investing. They go, oh, set it and forget it. I'm going to put it in an index fund. I'm going to pay off a mortgage. And then I'm going to hope in 30 years I can finally just bankrupt my family. I'm just going to spend all that money, right? And there's no replenish tool or anything like that. It's really frustrating because that's the mainstream advice out there that's mainly disappointing people with their results. It's a game of patience and discipline is what they want you to believe. But the wealthy aren't playing a game of just patience and discipline. They're playing a game of focus and value. They're playing a game of spend and replenish. They're playing a game of charitable, donations that actually benefit their family as well as charity, cutting the government out of the picture. It's a whole different world. And I think it's unfortunate that so much of the advice out there is mindless and set it and forget it. And really, I think the problem is what those gurus do is they go, and I've heard them say this, people are stupid, so let's just tell them the dumb path. Let's tell them the thing that is most mindless, just set money. But then the problem is they never learn to create cash flow. They never even get into a conversation considering legacy. They're overly reliant on a market they have no control over. And ultimately, they become in financial bondage in later years to interest rate fluctuations, tax fluctuations, and inflation. And so I'm glad that you're putting the book out there and the books that you're putting out there and that we're having these conversations as much as it's not a conversation because you just asked one question. I haven't shut up for 10 minutes, but
No, I love it. And everybody loves this. But, when I take my daughter to dance, I know a couple of the families there. They drive the nicest cars, wrapped in Gucci and all that fancy stuff. I'm wearing my Vans. They probably think I'm broke. But, I find out, that they're trust fund kids. Every month they get a check from a trust and they literally blow it all. They've never learned at the core how to manage money. They've never learned how to be a good steward of money. And they've certainly never learned anything about banking. They just give away the banking functions. All those cars that they're driving, those fancy cars, pretty much guarantee they're all leased or financed. They're making payments to somebody else's bank, not their own. And I think that's one of the fundamental differences. But, since everybody knows that, I think everybody on here doesn't want that for their family. They don't want their money to just be divvied up at certain ages and then squandered and spent so that, their name is forgotten. Garrett, one of the things, and this isn't something I read in the book, but this is back, when I first started in the industry. I don't remember who it was. Maybe Tom Hagna came in and he did a presentation about legacy. And it went something like this. He was explaining, what you want when you die is you want to make sure that your kids' remember your name. Now think about that. Like your kids will remember your name. Their kids will remember your name to a certain extent, but their kids won't even know who you were. And then the kids after that certainly won't know your name. So what he basically said is you build a system so that every year, every child that's born into your bloodline, they receive a check on their birthday. And that check is from Grandpa Chris. That sank into my mind. I never forgot this. I was probably 24 years old when I heard this, and I'm 48 today. And I kind of just carried that with me this whole time until I read your book, got into the legacy workbook, and just kind of really, really dialed it in and wrote out my family constitution. And in there, there's a very long section about that. And it's quite simple. The trust, after I die will be well funded. And then future family members, children will be able to borrow just like you explained, Garrett. And then their kids will be able to borrow they'll always have to repay it. And if they don't, when they die, it'll be replenished, right? And you mentioned that. But the one thing I wanted to do is, when I died, it was set up that every year, and they don't have to be big checks, $50, $100, those children receive a check every year. Do you think anyone will ever forget Grandpa Chris's name? No, because they know they get a check every year from Grandpa Chris, but they also will have to learn how Grandpa Chris did that. And that's going to be the core foundation of the family constitution and that. So Garrett, when we get into this, we're talking about all these different things, and you kind of did a great summary of all the different things, they need to look at, really, which all are three, those three things. And again, I'll just read them off to everybody: the family office, the family retreats, which sounds fun, and then the family constitution. But at the core, all of these trusts have life insurance policies. And I think that's a unique thing because in today's world, actually since pretty much the 80s, whole life has kind of been a bastardized product. It's been a product where people out there, it's very common to have here that whole life is the worst thing you could ever put your money into. But yet the Rockefellers, that's pretty much all they use. Now, what was it about whole life that they liked? And if we could talk about why is it that these trusts own whole life, what's the specifics of it, and get into some of the nuts and bolts about how a family member would borrow from the trust for whatever they want. Can you kind of elaborate on some of that?
Yeah, so why don't I give some background here of how this works in corporations and pensions. and what happened when they deviated from the very philosophy the Rockefellers use and corporate. So we go back to, I know it's a while ago, but 1947, GE had this philosophy. GE was like, hey, we want to be number one and number two in every category that we're operating in, and we're starting to slip in a few categories. So the only way we're going to become number one or number two is we're going to have to recruit from our competitors. And so they're like, well, if we're going to recruit, how are we going to get them to come here versus where they're at? They're like, we're going to offer them a pension. And it was called non-qualified deferred compensation. Non-qualified because it's not a 401k, IRA, or any government qualified plan. Deferred compensation because they were going to get it at retirement. Now, when they would recruit that person to hire them, the first thing they would do is buy whole life insurance on that executive. They would then fund the whole life policy, and they would use the cash value to supplement that pension. Depending on how long the person lived, the cash value might be enough. They might have to have some more that comes out. It just depends on how well they funded it. But here was the trick. When that executive died, they were going to die, and GE was still going to be around. So when they would die, the money would come back to GE that they had paid for the pension plus a positive rate of return. So they would just do this over and over again, just paying these pensions for decades and decades, and it worked like clockwork until Wall Street came along and they're like, hey, you guys are crazy. Look how good the market's doing. The 90s were like amazing, right? It's like irrational exuberance is what the Fed chair called it at the time. It was just like, it was double-digit positive returns. And so they're like, you guys could actually abandon this anemic, slow whole life. And instead, you should get into the market. And what you could do is you could start paying your pensions with these market funds, and you guys can end up making a bigger profit. Because maybe you're going to pay out 6%, but you're going to make 10, and that spread's going to be yours. And they're like, that sounds great. So they abandoned the whole life strategy, and they abandoned the Rockefeller method, and they went and did this with the stock market and not considering disinvesting. So here they're in the year 2000, the market goes down double digits. Let's just say it's only 10%. It went down by more than that. They still have to pay the pensions that year. So now it's double dipping. They have to take the loss and they have to sell more shares to pay for the pension. And then the next year was negative again. Oops. Now they had to do it again. And the next year was negative again. And all of a sudden disinvesting destroyed the account, because in a variable account, the 4% rule says if you take more than 4% in a variable account, you run the risk of completely destroying the account. And they've run different Monte Carlo simulations with different market returns to kind of come up with that number. And so they thought, hey, we don't need this foundational thing. We're going to abandon it. Now, let me give you a second story here, and then I'll tie it all together. Because we know that GE's pensions went bankrupt, right? So, I mean, and so did so many other places. But when I was first in this business, I was 19 years old. I finally, at 21 years old, I decided to approach a professor of mine. This professor managed $5 billion in municipal bond funds before he became a professor. And so he donated $250,000 to our class. We actually took $50,000 per group. We invested against the benchmark. And that's when I was like, I'm not going to be a money manager. Like, there's a lot of conjecture and there's a lot of risk in money management. I became more of an efficiency manager. Like, how do I save people tax? How do I save them on interest? How do I save them on non-performing fees? How do I design insurance appropriately? But I sat down with this professor who I was like, hey, you are the most prolific municipal bond fund manager of your time. But now that you're a professor, those tax advantage bonds don't give you the same benefit. And if we look at any 30-year period of time with one of 10 insurance companies, there's 10 companies right now that have built bonds in any 30-year period of time. So now you have a death benefit that comes along with this, and you're going to beat bonds. And what I told them is you don't have capital depreciation risk. Interest rates fluctuate. Your bond values can go down when interest rates go up because you have to sell your bonds for less because someone could go buy a new bond with a higher interest rate. So there is no capital depreciation. Once a dividend's paid, it becomes guaranteed, and there's a minimum guaranteed interest rate. So I showed him that, and I said, and it's still tax advantaged. So what if you allocated towards this instead of municipal bonds? And by the way, best fund manager on the planet for municipal bonds goes, that makes a lot of sense. Why? Because I also said you get this death benefit. This death benefit is going to come along for the ride. And now what you have permission to do is be more charitable or spend some of the money with your family with experiences, knowing it's going to be replenished to the trust when you die. And so he allocated 6 figures towards this, every single year. And here we are 25 years later, it beat bonds. It beat the bond portfolio, and he now has a death benefit that, he doesn't have to pay any more into it, but it makes sense to pay more because every time he puts a deposit, a lot more is coming in dividend and interest, and it's tax advantage. So it's a highly efficient tool at this point. So he is someone who could have got the best returns on a fixed income portfolio, and yet cash value made sense to him. I'm not saying that cash value is always going to outperform all these other investments that are out there. It's a savings tool. It's a place to store your capital. It's a way to buy your net worth when you acquire the death benefit. And here's the key. If someone can pull money out of their cash value in the future instead of a variable account, when those accounts, like if GE just would have had cash value insurance still part of their portfolio, instead of their entire pension being in the stock market, they could have pulled during those 3 negative years from the cash value and allowed the market to recover, which would have given them 33% more income from their pensions over the next 10 years. But because they didn't have a distribution diversification, because they didn't have cash value, and they were completely in something variable, they played a risky game and it destroyed their pension. So what the Rockefellers understand is the Rockefellers know how to make money. They know how to build businesses. They use insurance to protect, preserve, and perpetuate what they build because they don't control so many economic factors. I mean, hell, we don't know when we're going to die. George Steinbrenner from the Yankees died in a year where there were no estate tax. I feel like it was probably intentional. Like, George, you owe it to the team. Just get out of here. We won't have to pay these estate taxes. The Rockefellers couldn't predict when all their family members would die, so they could own it inside of a special trust that keeps it out of the estate, but still gives them access to the cash value. And now they don't have to rely on market performance to dictate the quality of their life. And so I think that all those things are very foundational to the Rockefeller method, because I always say buy net worth, build cash flow. And a death benefit buys your future net worth from day one, so you can focus more on building cash flow. So if you're a business owner, you can grow your business. And the life insurance becomes a way to transfer your business wealth into your personal wealth, so you have stable foundational pieces that are guaranteed and that you can count on, because there's an economic value to that certainty. And the death benefit replenishes whatever's spent during your lifetime back into the trust. So hopefully next generations, you might just be the bank. You might say, we're going to finance every house for our grandkids and great grandkids because we'll take the interest instead of the bank taking it. We won't have quite as strict of underwriting, so they don't have to jump through the hoops during really difficult times. And we don't have to be subject to whatever the Fed's whims are. So if the interest rates go from 2.75 to 8%, it's not going to, it's not going to prevent my kids from having a home or my grandkids from having a home. And I don't even have to invest in the market because I got collateral with the trust. They're paying interest into it, and it's just being recaptured right there for their future posterity and heirs. I obviously get excited about this and love that kind of a system, but I wanted to give some of that background stuff that isn't necessarily always in the book. And those two stories, I think, are instrumental to understand why Rockefeller method in insurance is so valuable. It's not just about chasing some return. It's about stability. It's about efficiency. It's about benefits. And it's about a death benefit replenishing whatever you spend during your life.
I think that's phenomenal. I hope every one of you were paying very close attention to that. So a few things that were just phenomenal in that story. And I'd never heard that story about your professor with the muni bonds. When you really think about a whole life policy and you think about the internal rate of return, just putting money in the whole life and just letting it grow over time, like that internal rate of return, it's not a sexy number. But when you put that up against like a bond portfolio or the other places that you could go out and get a relatively safe return or a federally insured return like a treasury bond, they're pretty much par. Like, some years the bonds might beat the whole life, other years the whole life will beat the bonds. Now, there's a couple of factors too. Is the whole life, if structured properly, can grow, the internal cash value growth is tax-free. So unless the bonds, like munis, are growing federally tax-free and I guess state tax-free too, if you could find one that did that, then now it's the same. But that's tough for most people to do. They're not going to just put all their money in municipal bonds just for the tax savings. And plus, muni bonds pay a little bit lower amount, which is why your professor was like, hey, the whole life beat out the muni bonds.
Yep.
So the tax equivalent yield you'd have to get in a treasury bond portfolio is not the same as what you need to get in a whole life. It's significantly more, especially if you're a high income earner or in a high tax bracket. So these are the different factors. But you said something I've never heard you say, but I heard an article or a video somewhere, probably on YouTube. It was this family office guy, and he was asked about whole life insurance. And he says, it's great. Every one of our clients have it. And the guy was kind of dumbfounded. He's like, you're a family office. Like, you guys are like investment managers, but you recommend whole life. And the guy's like, it's so simple. He says, we invest money for our clients. And some of our clients, we invest in very speculative investments. It takes on a lot of risk. The whole life policy is literally just there to basically be a buffer if we lose money for the future generation. So this whole life provides a death benefit. So we can take these risks and try to grow this money. But if something bad happens, if we catch it wrong, if the markets turn on us unexpectedly, if something happens and that person passes away, the death benefit in the life insurance pads for future generations. So those losses are just erased. Like, we don't need to worry about it. We can take more risk because we've got almost an insurance. Well, I mean, it is. It's almost it's an insurance policy, but they're looking at it as insurance against losses in their speculative portfolios. And you kind of mentioned that too. GE took the bait. And folks, a lot of you probably don't know this, but even in today's world, I know pensions are all but gone, but in very small, closely held companies, a lot of surgeons and dentists and doctors' offices where the doc's older and the staff is younger, they love 412(b)(3) plans. Look it up. It's just the tax code, or cash balance plans. Guess what those are funded by? Whole life insurance and fixed annuities, the two most boring things you can, guaranteed. But because of the return being lower, because they're guaranteed, it allows these docs to put a lot more money into these pension plans, get a lot more tax deductions. So you see, this is still used today. It's just the average person and the average advisor out there isn't talking about it because it's not sexy. But you mentioned a time frame, and then I'm going to shut up and I want to go to the next thing. You mentioned a time frame, the 90s. Like, it was just a period of time. Like, if you study it, folks, like Garrett has and like I have, it was almost like you could do no wrong in investing. I mean, watch the movies during that time frame. You see it. Everybody was, seemingly wealthy. Everybody was investing until they got to the end of the 90s. Okay, and then you went into the 2000s and the dot-com bust. Now, a lot of people, on here probably remember that, but a lot of folks that, it's funny, I think, Garrett, it's 38 years old, if I'm not mistaken. If someone's 38 years old or younger, they've never felt the impact of a recession. And I'm going even the Great Recession. This is just showing we're getting older. But the dot-com crash was a doozy. It's how I entered the Wall Street world as an advisor, because I couldn't pay my bills with my business. And it was 2003 when I entered. So the dot-com crash, okay, which was a tech crash at its core, was 3 years of negative returns in the markets. So we really don't think about that, but that was awful. So companies like, you talked about GE, but I know GM was suffering during there, and GM took their big dive after the Great Recession. I remember that. Their pension dried up. They had to go to the pension guarantee fund. My whole family worked for GE or GM, so I know how that works. So all of these ginormous corporations took the bait, took the risk, went into the markets, and then all of a sudden the markets served them a really hard pill to swallow.
Chris, like, this is what's crazy to me is those pensions had the world-class money managers because there's billions of dollars.
Best of the best.
And then now what they're saying is, oh, we're not going to do defined benefit. We're going to do defined contribution. So we'll match your 401k. Then giving it to okay, now I'm putting it on the worker. The worker's not a world-class money manager. And if the world-class money managers couldn't get it right for retirement and retirement benefits, this is why 95% of people are not economically independent at age 65. Because it's like asinine to me that they're taught to just set money aside into a retirement plan, pay off their loans, and then live off the interest in retirement. Well, if you live off the interest, you're subject to a lot of things that could just confiscate lifestyle from you. And if you didn't learn how to create cash flow over your 30, 40 years of working, just socking it away, and now your entire outcome of your income is dependent upon you creating cash flow from an asset you never learned to create cash flow from. This is why it's a broken model and a broken system, and the mindlessness isn't working. People are being taught to be mindless, and it's not helping them. That's why I love that people are on here today being educated, is because retirement plans have failed the population massively, and even the person that invented them is disappointed and now writing against them, because all it did was shift the focus from companies taking risk to individuals taking risk on risks that they don't understand and that the gurus don't actually talk about. They just set it aside and hope for the best, and it just isn't working out.
Well, Garrett, I remember back as an advisor, and like you, probably like most advisors, first we were told to be salespeople, then we were told how investments worked, and then if you were in the game long enough, you actually learned some of the valuable stuff. But that was like 6+ years on when you were already successful.
All
One of the
sales,
things you,
all sales training my first few years, just
oh,
sales
100%
training.
sales training. We were
I
just
had to,
glorified
yeah,
salespeople. That's it.
I had to
With
go.
a license to invest.
I had to travel somewhere every month for 26 straight months from the time I was a senior in college to interview people to get to the bottom of what was going on. I had to fly in and meet with the people at the home offices, from product designers to actuaries, to find what the real story was, because everything that was going on in my agency was sales training, sales training, sales training. And so it cost me a lot more to get trained outside of school and outside of that classroom of finance to learn what we're talking about here today, because I had to go meet with the people that were like, I just leveraged my young age at the time. I was in my early 20s. So I remember I spoke at an agency when I was 21 years old. It was just an insurance agency. I was nervous as hell because I didn't have a lot of real practical application, but I had read this article about charitable trusts. And so I got up and I spoke about charitable trusts. And so this guy comes up, he's like, hey man, I've been in the insurance business for 20 years. I got my dad a whole life policy. He's about to sell his business. Do you think he should do a charitable trust? I'm like, possibly. He's like, could you help us? I'm like, sure. Chris, I shouldn't have said sure. That's a little bit confident. I should have said, I don't know. I read a damn article. What do I know? So we go meet with this dude's attorney. It's him and his dad and his attorney. And it was like the messiest office ever, just files everywhere. And I'm like, I was thinking we might do a charitable trust for the sale of this business. And he just crushes me because I really didn't know what I was talking about. Hammers me. We leave the meeting. I'm just feeling bad about myself, but I'm at least resourceful enough that I call the attorney that wrote the article. I get a hold of his secretary. I'm like, hey, I'd love to meet with Greg. Like, I'm 21. I try to bring this idea. This attorney says it's not possible, but reading Greg's article, I think it is possible. He gets on the phone with me. He's like, I love that you're making this call. This is great. Bring him in the office. We end up doing it, $1.7 million exit. They save a couple $100,000 of tax. They have an extra 25% cash flow during their entire life after the exit because of having a death benefit in place already, because of learning about a charitable trust from an article. And again, I never learned about that when I was in my financial world. I had to learn about it outside of that. I had to go
Absolutely.
reach out and talk to the people that were behind all of this stuff. And so I think that's where you and I are alike. We just don't stop until we figure out the answers, and we question everything until we get to the bottom of it.
And that's a big common misconception. I want everybody to know this. Like, just because somebody's got a license to sell securities, Series 7, maybe they're a financial advisor, Series 65, any of those security licenses that they might have. What you just heard from Garrett and what I'll, echo is you're not taught the things you really need. So like when you are finally out there and you're a financial advisor, you're so excited in your fancy suit, like you really know nothing. Stephen can say this. Stephen was a financial advisor. He was just a trained sales professional as well, until like you went out and you actually were seeking the knowledge because, well, you were put in a difficult situation. So you challenged yourself and you're like, I think this is right. And you were, they weren't, but you had to go out and seek that knowledge. And that's what every advisor should be doing, is seeking the knowledge. But the advisor world, and I promise folks, we're going to get back to what would the Rockefellers do in trust, but this is an important one. The advisory world, the financial advisory world, is very fractured and broken right now. Most financial advisors won't advise you on the things that you need advice on, like your 401k and the assets that the advisor doesn't manage and have under AUM, because they don't get paid for it. They don't want to manage your cash. They don't want to do that. So like, what Brandon with PMC Wealth has done is completely changed the whole dynamic of that and doing financial advisory different, doing it, by what he thinks is the right way to do it, against the grain. But now, one of the other things you said, and then I promise we're going to get back to trust and everything, because I know a lot of people are like, well, tell me about those trust things, because there's always so much, like everybody wants to know all about trust. And it's like, it's really quite simple. There's two, and then there's variants of those two. It's like, We'll get into that. But you mentioned something I thought was brilliant. And back to the GE story. I'm going to call it a volatility buffer. There was a white paper that I got so wrapped up into. Wade Foe wrote it, and I didn't just read it. I wrote it and rewrote it and did like 3 or 4 YouTube videos with Craig on how to use whole life as a volatility buffer, but then how to layer IBC into that volatility buffer. So now you had another way to make income and use it as your banking. So it was just this whole thing. I literally nerded out on it. But like, that's what you did with this charitable trust, right? You nerded out on it and you went to the source. And what you learned there, probably 98% of every financial advisor will never understand. So let's get back to trust and just the fundamentals and kind of tied into the Rockefellers had very elaborate trust structures. And the average person, the 160 some people on here, they don't need what the Rockefellers had, but they need to understand why the Rockefellers had trust. And can you just take that and run with that a little bit?
You bet. So just remember, own nothing, control everything. When something's at arm's length, all of a sudden it's protected. So the more success you have, the more financial predators are going to come your way. They're going to try to get what you have. So if you can have a trust that's irrevocable, an irrevocable trust will protect you while you're alive. A revocable trust will protect you after you're dead, as far as it becomes irrevocable. So those are the two main types of trusts, revocable and irrevocable. Back in the day, irrevocable trusts were a little bit problematic in that if I set up an irrevocable life insurance trust, it was very hard to ever use my cash value. So it kind of damaged the problem with IBC, right? It created an issue. In 2013, we came out with Domestic Asset Protection Trust in the United States, primarily as an answer to people moving so much money offshore. And in a Domestic Asset Protection Trust, you can have a distribution trustee. A Domestic Asset Protection Trust is irrevocable in nature, so it is arm's length. But the thing is, you control the distribution trustee. So if I make Chris my distribution trustee and I say, hey, I want some money, and he goes, no, well, I could fire him and hire a new distribution trustee. And so it gives me control over the money, but I don't own it. The trust owns the money. And a trust is especially important when you're passing money on from generation to generation, and a perpetual trust, which some states are not perpetual and others are, so that it can continue from generation to generation in the intent of what you had with the money. And so you can have everything from insurance trustees, distribution trustees, investment trustees. You can separate that out to protect how the money gets managed based upon the terms that you've created. You can even create a trust protector. My attorney's a trust protector that can veto if my board comes together and they do anything that would be against what my value system was. Like if they're like, oh, we're just going to put it in index funds. Well, that's not what I'm about. I'm about investing in my heirs. So are they starting businesses that we can help finance or fund? Are they buying real estate that we could finance? Are they doing things that are going to help grow them? Because I want to grow them so the estate continues to grow, not just grow the estate without them benefiting from it or not knowing it. Because Chris, what I found is the more someone's estate grows and the people don't grow with it, the gap is called risk. So for example, if someone invests in something they know nothing about and it goes up in value, but they don't understand why or have no exit strategy or don't know how to benefit from it, they're going to destroy that return to some degree, either by holding on forever or cashing out early. I mean, Bitcoin's like the best example of this. I know someone that owned 90,000 Bitcoin, but sold it before it hit $1. So, that's billions of dollars now. They didn't have the knowledge of what they had, therefore it had a major cost. So a trust essentially says, I'm going to put my assets in there, my, everything. And a revocable trust is for people that are just starting out. They don't have millions of dollars in net worth, but what it does is it spells out what happens after they die. And that's where you can have all these tools like a family constitution is the preamble of the trust. And then you can have the legalese that's required. When you have a trust, you avoid probate. If you hit probate, all of your assets become public knowledge and the court is now in charge of what happens. You do not want that, and I don't think you have to be worth millions of dollars to protect from making millions of dollars of mistakes, because a trust is essential upon your death. Otherwise, especially if you're learning what you're learning here and with the Rockefeller method to get insurance, a trust is essential, because if you don't have a trust and that death benefit just goes on to the heirs, who knows what's going to happen with that? Who knows what's going on in their life? So the trust is what protects, preserves, and perpetuates it. And how you spell out the things in the trust are essential. You really showed that at the very beginning of this, and I thought was brilliant. And when people get what the Rockefellers do, they're going to get the Legacy Builder Toolkit, which helps them establish their family constitution, which helps them establish how to set up their family retreat, which helps establish paying their kids. Because if you're a business owner, you can pay your kids up to $14,000 tax-free. That can go into your cash value of the kids' policy and grow tax advantaged. And you can even access it tax-free, which is the very first part of the Legacy Builder Toolkit, that people get great ideas on what to hire your kids for and how you can save tax and how you can find places to fund the premium. But yeah, revocable or irrevocable trust. Yeah, there's dynastic trusts that the Rockefellers use because they've got a whole different ball game. but just it's basically going to come down to, are you going to do a revocable trust because you're just starting out, or an irrevocable trust like a domestic asset protection trust because you're up in that upper echelon where you could have estate tax issues, or you really need to protect because people are coming after what you have. Because look, there's 20 million lawsuits a year in the United States alone. You know, is there that many people doing that many bad things? No, it's just that people are very money hungry. So this trust could be one of the great ways to keep it out of reach from those people.
Yeah, we definitely live in a time where people definitely are greedy. They just want to work less and take more from those that have, you know, it's just kind of one of those things that's happening right now. Now, I love that. And, you know, one of the problems we have today is there's a lot of companies who, I'll keep the names, you know, with just us, out there slinging trusts around and slinging a lot of irrevocable trusts around to people that don't even understand what an irrevocable trust is, why they would need an irrevocable trust. They got some fancy sales pitch. So you talked right there with the family constitution. In my video, I was talking about a revocable trust, my living trust. That's all I was talking about. And in New York, you know, our probate limits start at $50,000. So like, every car I have is over 50 grand. So every car I have needs to go into the trust or into an entity so that it's not going to become public knowledge when I die and not going to get squandered. So, or hit with probate. So that's simple, basic, fundamental planning. Now, when we go that next step, where do you draw the line for where someone like has a revocable trust to now they really need to start thinking about different types of irrevocable trusts? And then I also want to layer in foundations, because one of the best things I ever did, and I did this many years ago, was set up a private foundation. You know, a lot of people look at trust, and I'm going to hit one more thing. With the irrevocable trust, a lot of people are led to them because of promises or false claims of major tax savings and like this tax-free environment. And gosh, I've even heard, you know, there's one guy, God, I wish I could just call him out so everybody could avoid him, but he's telling you, get these irrevocable trusts, have your policies owned by it. You can tax deduct all the premiums and everything. And he doesn't explain all the negatives that come along with that. But anyway, I'm getting down a rabbit hole. So the private foundation was really a tax play first, but also a charitable play second. But now today, charity is the first and foremost of it. And like, we were just at my daughter's school today, and like numerous people came up and we didn't even know them, and they were thanking us for the renovations we did at the school through our foundation. And it's just like, we don't do it so people say thank you. We do it because it feels good, because it's the right thing to do, because we have the means to do it. And, you know, same thing with animal shelters and child trafficking and all these different things that we give from our foundation. But the foundation initially was brought to us as a tax deductible vehicle where we could put money into this, and that money that goes in gave us a tax deduction. And then we controlled the money in there, we could invest it, and then we could give it, and we had to give 5% a year. So I kind of just almost took you through like almost a waterfall, like, yeah, revocable, irrevocable, and then foundation. But what is your take on that, on you know, the folks that are on here? We have a varying group here, I'm sure. I've seen some of the names. We have some high net worth folks on here. Yeah. We have some folks that are kind of just at the early stages. So like, what would you say would be that kind of step one, step two, step three, and then like now we get real crazy?
Yeah, so step one, most people, a revocable living trust is going to be key, with wills that are pour over wills in case something doesn't get put in there, and also medical directives, so that you say, hey, when do you want someone to pull the plug, take the decision out of their hands where they're emotional, and then, you know, who do you want making your medical decisions if you're incapacitated, and then a springing power of attorney that just says, hey, if I'm not able to make the decisions, I want to make sure that my family can make the decisions, and here's a power of attorney to allow them to do that. So that's a pretty basic legacy planning package. If you add the family constitution, look, we've got, you know, I'm getting so effective at helping people build these because I've built so many. But it's like that letter of wishes, statement of purpose at the very beginning of your trust, that says who you are, what you stand for, why you set this up, what you hope it provides. And, you know, in the Legacy Builder Toolkit, when they get what the Rockefellers do, they can build that infrastructure. You know, it takes time, like you said, but it's at least they're not starting from scratch like when I was building mine back in the day, and, you know, it took days and you know, well, days and days and months and then years before it finally got finished because it got too lengthy and had to cut it back. But now there's a framework for it. So if you're wealthier, if you've got a business, if you've got, you know, millions and millions of dollars, that's when you start considering a domestic asset protection trust. And in that situation, now you've got a position where it's irrevocable, but you still have access to your capital. So it's outside of your estate. So you're not hitting that estate tax when you die. The other thing is you having a family foundation. I love that. And I think that, if someone wants to have a family foundation because they're really charitable in nature, that's amazing. Or they can use a charitable remainder trust if they have a charity that they love. So it's whether you're going to do the work internally or whether you're going to do it, just hand it off externally. You make that choice. If you are charitable, there's such great ability for you to be more tax efficient because you could donate a capital gain asset to a foundation or to a charitable trust. When you donate it, you pay zero tax upon the sale of that asset, but you're the first beneficiary of the trust. The charity is the second beneficiary. So ultimately, you can have a lifetime income without any tax on those capital gain assets, whether it's real estate, a business, whether it's a stock, and then get that lifetime income. When you die, the charity keeps whatever's left over, which they aim for around 10% typically. Well, guess what? Your death benefit can replenish that. So it's like a permission. See, if you do it right, like Chris is talking about, you can give your money away. You can spend more during your lifetime because of it, because you're the first beneficiary, the charity is the second beneficiary, and the death benefit can replenish it so you don't disinherit the entire ecoverse and banking system that you're building for future generations. So give, spend, basically give more, spend more, and ultimately still replenish. And if you do that from generation to generation, look at how many people we think are the biggest philanthropists in the world. They're just really intelligent and savvy when it comes to their finances. And yes, it happens to do a lot of good as well, but they're definitely looking at the tax strategy behind it as well as the philanthropy. There are other people that put philanthropy first. Like you said, for you, it started out as a good tax strategy. Now it's like, it's first and foremost the benefit that you're creating with the charity and secondarily the tax strategy. But man, isn't that pretty cool that I loved writing about that in Rockefellers. It's just the concept of looking at this death benefit as a living asset, as a way to replenish so that you have permission to be more charitable. So you have permission to spend more of your own money knowing it's going to be replenished. Those without a death benefit, this is where in Killing Sacred Cows, I think that is probably the most effective chapter that I've ever written on insurance is the self-insurance chapter. And it says self-insurance is a lie. Because when we think that we don't need insurance and we're just going to use our own funds, we lock away our money. So think of this. I want to buy insurance by paying pennies on the dollar. When you use your own cash, you spend at least $1 for $1 of insurance and you tie it up where you might not be as productive. So people that don't have life insurance, and Chris, this is what's kind of ironic to me, is I'll meet with people like, yeah, I'm just going to buy term and invest the difference. Then one day I'm going to have enough assets, I'll get rid of the term insurance. I'm like, and let me tell you the rest of the story. And then when you're older, you're going to meet an attorney that says, hey, you got a state tax problem. Now you need to buy insurance when you're in your 70s, where you could have just made an asset allocation decision, saved some taxes, had the death benefit come along for the ride like the professor I talked about. And now you have this great asset that opens up possibility for your other assets to be better performers. You can take a reverse mortgage if you wanted and then replenish that with the death benefit. So it gives you tax-free money on a lazy dead asset that you get a lifestyle from, but not cash flow. It now turns into a cash flow asset. Or you could just, we talked about fixed annuities briefly. You could take a faster pay down on something like that, knowing it's going to be replenished. You can spend down assets instead of just off the interest if inflation's higher or taxes go up. So it gives you that buoyancy or those contingency factors. That death benefit gives you anywhere from 20 to 50% more cash flow from other assets when it's symbiotic and coordinated. That's the key. So otherwise, no death benefit. Now you want to do a family foundation in your 70s. You're going to take all that extra cash flow that you get from the charity and have to buy insurance and still get less than you would have got had you started earlier using the methodologies that you and I teach. So I know, I get excited about that.
Well, I just love the use of permission slip. We all from school, we remember permission slips. When you didn't want to go to school, you got your mom or somebody to write the permission slip. We all remember that. And then there was the hall passes and all those things. So think of that, what he just mentioned. It's your permission slip. It really is. And I love that you kind of went right over buy term invest the difference. But, Craig did the most comprehensive white paper I think ever created about buy term invest the difference. It's almost an overkill where it goes through and does multiple side-by-side examples of buy term invest the difference against, a whole life using IBC. Apple for apple comparisons. And folks, if you haven't gotten this yet, just email us or put it over in the Q&A and, Craig will kind of take it down and get you it. But this literally sums it up. Like you're not buying a permission slip when you buy term and invest the difference. And also, like you said, most people that buy term and invest the difference, I don't know what the percentage is, but I'm sure it's in the high 90%. They never save the difference. Or even if they do start with saving the difference, that never lasts. It never makes it. because you didn't do it fundamentally sound. And, you know, one other thing, I just had it in my head. Now I'm going to lose it. You said something else and I completely forgot it, but it's all right. We'll come back to that. But I love that you talked about buy term, invest the difference and how all that works. Now, one thing I heard you and Michael talk a lot about that I want to make sure we hit, because a lot of people don't understand this, is human life value.
Yeah.
You had a very unique way, and I saw this out at Caleb Gilliam's event out in, I think we were in Colorado, if I'm not mistaken.
Yep.
You guys talked about human life value. And folks, if you have never read Caleb's book, it's called The And Asset. Must read. So all of you are going to get this. Actually, let's pause real quick. Stephen and Craig and Shauna, if you could put up the link so everybody on here can get a copy of What Would the Rockefellers Do? So we've got an offer. Every one of you are going to get a copy of this. You can get an ebook or you can get the hardcover book. If you get the hardcover, you just pay the shipping. And then also, I believe ours has the Legacy Wealth Builder. Sorry, I said that wrong. No, I said that right, didn't I?
Yep.
Legacy Wealth Builder?
The Legacy Builder Toolkit. You have the Legacy Builder Toolkit in that. Yep.
So you all get that, and that is an essential read. That is how I did all that stuff that you saw in the video. So all of you, I want every one of you to get that. So there it is, the book special. Just click that link. We'll give you a copy of the book. So I want you to have that. But Caleb's book called The And Asset explains that it's not whole life or S&P 500. It's not whole life or real estate, whole life or Bitcoin. It's whole life and all those things. It's the and asset. And that is one of the most pivotal, it's really a mindset book. It's about just fundamentally changing your mind on how it actually works instead of trying to always pair one against the other. How many times, Garrett, did you hear from a financial advisor being like, oh, I can't believe they're recommending a whole life, like put it over here. And then they do this long, elaborate like proposal showing how the S&P or the stock portfolio beats the whole life. And like, you're just like, this guy just wasted so much time because we weren't ever talking about not investing with him. We were just saying, change where the money goes first and then invest with him. This and that. Like, have you had that happen?
You know, it's interesting because like 27 years ago when I started, it happened more frequently. But I feel like you and I and other people like us have done a good job educating the public. You know, you look at how many copies Rockefellers have sold, probably like, I don't know, it's hundreds of thousands now. It's helped that the conversation becomes less and less likely to be that way because of the work that we've done. It used to be a common occurrence, and now it's a rare occurrence. So yes, I've been there, I've seen it, I've heard it, but I just want to acknowledge you and so many of the people out there that are doing this kind of work because it's more commonplace. When I was 19, I was 18, I heard whole life is a hole you throw your money into. And they showed me illegally 18% return on stock market on a separate spreadsheet and said, look, let's do variable universal life insurance. You can put $70 a month, you'll be a multimillionaire. And then I did an econometrics project while I was in college, a thesis on it. And I was like, oh, this has a 97.8% chance of failing because the cost of insurance will go up in the years the market goes down because of the net cost. And so I was like, damn, this sucks. And so when I think about buy term and invest the difference, I'm like, hey, why would we want to self-insure? Because now we have to tie assets up. I mean, imagine if someone even paid off their mortgage and they're like, cool, I'm going to get rid of my homeowner's insurance because I've got the cash. I'm just going to keep it at the bank in case something happens to my house. Well, you have the opportunity cost of what you could earn with that money versus tying it up. And that opportunity cost is going to be much greater than the savings of not having to pay for homeowner's insurance, which might be a couple $1,000s a year. And so when we think in the world of investing in production, insurance can help us to become more productive because it allows us to have more freedom with our assets, knowing that we have something to replenish them in the future, knowing that we bought that net worth instead of just tried to build it, knowing that we've got stability and access to capital along the way with the cash value. I use my cash value when I know, like when I have like a dynamite deal where I'm like, man, I'm going to be able to turn this back around quickly, buying a highly sought after piece of land or a property. And then, you know, everybody else needs months. And I'm like, cool, I can get that done in 5 days if you'd like. I just need an inspection. And I make the order for the cash value that day. I mean, it's such a strategic advantage. And if we look at just fixed income, CDs, money markets, bonds, cash value will suffer in the short term to those because we've capitalized the death benefit. They've got to put some money aside in case someone dies. They do have to pay commissions to make these things types of things happen. But the reality is every year that we're around, and the closer we get to 20, 30 years down the road, the dividend almost becomes what's credited because the longer we have it, the more efficient it becomes.
Absolutely.
And so I just think that, man, that's it's been my never fail me strategy. I've lost money in things like crypto. I've lost money in things like real estate. I've lost money in oil and gas. I've done bridge financing. I've done a lot over the last 27 years with my investing career. But the thing that has been stable, secure, and that I've always been able to count on has really been my cash value and my whole life policy. So I'm more calculated of like, I want the max death benefit an insurance company will give me. I've got 27 whole life policies. I have one premium financed IUL. So, but the problem with that is I can't use the cash. That's a pure death benefit play only. My cash value of my 27 policies is something I use. I actually took a loan last week as I'm looking to extend and do something in my business. So it's just been instrumental and valuable.
I like that you mentioned IUL because a lot of folks, they get confused between these specially designed whole life and IULs, and that's the commonality right now is IULs. That's the most prevalent insurance policy sold. I mean, there's lots of reasons, high commissions and things, but what you mentioned is a really good use case for IUL, and that is premium financing. They work really well for that, and that's not something I ever really talk about, but your IUL is part of your premium financing. You were literally using that for the death benefit. And I'm glad that you mentioned that. That's not something we ever really talk about.
And in the rewrite of what with the Rockefellers do, I had to mention IUL is not a product or VUL or UL that works with the Rockefeller method. We want a policy that's guaranteed to be around one day longer than the individual that's insured, which we need as many guarantees as possible for that to happen. And now, like with these mutual companies, it's kind of like the last de-risked asset that's available. I mean, you've got policies that are, companies around 180 some years now, and that have always paid a dividend and have a minimum guaranteed interest rate. And so you can push the risk onto them instead of take the risk. Where else can you do that?
That's key.
You know,
who do you want to hold the risk? Do you want to hold all the risk, or do you want the insurance company to hold the risk? That's the question that needs to be answered first and foremost to decide whole life or VUL, IUL, or one of those.
Because the risk is shifted to the individual when you have IUL, because you have mortality costs that could go up over time depending on your death benefit minus your cash value. That's your net amount at risk. So if that net amount at risk is decreasing, it might not look like the cost of insurance is being impacted, because as your age goes up and it's built on a term chassis, it's kind of masking that until you use the cash. Now you use the cash, that could start creating some risk for you. It could be that how many people per 1,000 died that own that policy, and they jump ship to a policy that had better deals, but you're not in the same health. And so now you're stuck with a higher cost of insurance that the insurance company could do. And there's just too many moving levers, right? Yeah. We've got cap rates, we've got spreads, what you're getting paid versus what's being earned. That's a spread, or a cap rate when they stop paying once it hits a certain level, or participation rate. You might only get a certain percentage of whatever is being earned, So like those three factors, including the cost of insurance, when people are told, hey, it's downside protection with upside potential, I've just seen it illustrated with much too high of upside potential, because they act like you're gonna get 8% every year. And the reality is you're capped out at 10 some years, and some years you're getting 0. And if you're gonna invest in the market, just go invest in the market. Don't mess with your insurance.
Exactly.
At the market. Like, keep your insurance in whole life, where you've got a minimum guaranteed premium, a minimum guaranteed death benefit, a minimum guaranteed interest rate, and once a dividend is paid, it becomes guaranteed, and they don't change your cost of insurance unless it's going down. And so that's the game that I want to play. Transfer the risk and create certainty,
100%. I literally can't comment at all on that. You just nailed it. But it will be interesting. 20, 30 years from now, we'll both be around. We'll look back at this and we'll see the carnage that happened in the IUL industry and in the IUL products, and how many of them didn't make the cut when we go through a recession or two. And it's going to be really funny because the book's already been written on this. They were called VULs. 2008 was the proving ground for them, and they failed miserably. I owned one, and the only reason it didn't go belly up and lapse was because New York Life put their foot down and said, hey, listen, during this period, we're not going to allow any of these policies to lapse because of the separate accounts. And without that, almost all those VULs would have lapsed. And a very similar outcome will come with IULs for those that are done improperly and not paying attention. But again, it'll be 20 years, and I don't ever want to be sitting there in 20 years and be like, I told you so. Because that's just not the world I want to live in. I want to live in a world where people are protected now, so that 20 years from now, 30 years from now, what they had what they did, what planning they put in place is still there and is exactly what they wanted it to be the day they bought it. And unfortunately, for many, that won't be the case.
Yeah, we don't want to say I told you so because that sucks for everybody.
All right.
We just want to speak the truth now and be as clear as we possibly can. And what Chris says is kind of haunting, that it might be 9 out of 10 policies being sold right now are IUL. It might be that high. And
it's the king of the multi-level marketing.
Right. And the thing is, it's just going to be such a disappointment because you have people that are taking all of their savings and putting it there, and they don't understand the rising cost of insurance or the caps on the participation rate or all these kind of things. And so it's, to me, that's why we have a responsibility to get the books out that we're getting out, writing as often as we are, speaking as often as we are, because it's just, this is people's life. This is like, they can't look back 30 years from now and be like, man, I wish I would have done something different because now I'm screwed. Because if the cost of insurance goes up a certain amount and they don't hit the premium lapse guarantee, they could lose the death benefit and get a tax bill instead of cash. Like, right. Why would you want to put yourself in a position where that's even a remote possibility? And I've actually had really good friends that have a whole life policy and they go, oh, I'm going to cash this in for an IUL. I'm like, dude, would you be willing to read some of my stuff? Maybe listen to some things beforehand? Like, why would you take that risk? Like, everything that they're saying, even if it came true, it's negligibly better. But if you look at a contract, if you look at a whole life contract, and then you look at an IUL contract, an IUL contract will have 4 times the pages, because that's how many moving pieces and parts there are that the agents themselves don't understand. Why? Because what were Chris and I taught when we first entered the industry? How to sell, not the truth about money. And so it's not that they're bad people, it's they're misinformed people that are promulgating bad advice and putting people in a bad situation. And they're not going to be around to watch the thing implode because so many of them are just showing up, selling a few policies, and then moving on with their life. They're not like, it would be shocking if Chris and I weren't doing this 20 years from now, 30 years from now, because we've invested so heavily and I don't ever plan on retiring. I mean, it's not in the cards. I took 3 months off after selling my business, and it was my worst 3 months I've ever had in my life. I was really
talk
bored.
About that a lot.
Nobody wanted to hang out in the middle of the week. I didn't know what to do. There's nothing. I'm tired of everything that's streaming, and I was like, cool. I'm back in the financial game. So I've been full force ever since, and it gives me a sense of purpose. I see all these amazing kind comments here about the work, and it's like that's so much more valuable than just sitting around. I don't know. I have a lot of hobbies, but there's only so much time I can spend in a hobby, Chris.
Well, it's amazing. I mean, we just sold out of your books, according to what Steve. I'm just kidding, folks. There was an error. We're fixing it right now. So if you're clicking the link, it's saying that we're currently showing we have no more books. I promise you, the warehouse has lots and lots of books. We printed, I don't know how many we printed, Garrett, but a lot. So
I love it.
Let us get that fixed. We'll put that back up there. But real quick, folks, also, I want to, Garrett's got a hard stop at 2:30 Eastern. So I want to make sure we hit your questions. But one of the things I do want to say is many of you are kind of in the comments and in the chat, in the Q&A, are saying, I need to talk to somebody. So what we're going to do is we're going to put up a link. If you want to get on the phone with one of our money mentors, just talk through your situation, talk through this stuff. We would love to. And, here's the thing. When you get on the phone with us, we're not trained to sell. We're trained to solve a problem for you and listen. And that's the single most important thing. And also the biggest difference from mine, Garrett's, and Steven's X world, where we were taught to be sales. Here, we're just problem solving. Okay, that's what we're doing. Everybody's got a different problem. Let's figure that problem out. Let's go through it and see if we can mathematically solve the problem. Garrett, I don't know if you have heard or kind of seen, but Craig and I have been working on something really special, something that's been a 2-year-long project. It's called the Vault. It's a revolutionary software. Think of it as an operating system for IBC, and then we mix velocity banking into it. It is the one thing that, I just wanted to take a second to just call it out. The one thing we looked at years ago, and I'm sure you have too, is, what R. Nelson Nash came up with, the infinite banking concept. It was all conceptual. It was conceptual theory of how this works. And it worked exactly that way, but it was basically just, this is a concept, it's a process. In that process, what Craig and I found, more specifically Craig, is that this is just a mathematical problem. That's all it is. Every one of these problems can be solved with math, because that's what finance is, math. So we literally came up with a software, and it was built with different spreadsheets and different math problems that we came up with. And we built software that mathematically proves every single scenario. So how we do it is we do comparisons, kind of like, is it by term invested difference or whole life and IBC that works? So, well, it's a mathematical equation. We can run the math. So the Vault software becomes an operating system for your private banking system that allows you to run the mathematics to say, does this solve my problem? And does it math? That's the simplest thing. And because the one truth is math. So if the math proves it, well, that's it. And that's what the software does. So you'll be hearing more about that, Garrett. But I just wanted to make sure I gave a shout out to Mr. Craig Yenny for his hard work. It's been a 2-year labor of love. And I wanted to bring that up because you had mentioned, you retired and then you're like, oh, this sucks. And you went back to your passion, because I think that's a really important thing. We're talking about the Rockefellers and, building, what would the Rockefellers do and the trust and everything. And a lot of that is planning for the day we're gone. But let's also focus on while we're living. And let's also not just focus on the lie we've been told that we should work till 59 and a half. And at 59 and a half, that's the magic date somebody mentioned on the 401k where we can retire. We get a permission slip to retire by the government at 59 and a half. But yet your 401k probably doesn't have enough money, so you're going to retire, learn the same thing Garrett did or not, and then probably die early, because the statistics show that most people that retire and go off into retirement and do nothing, they don't have a purpose, they don't have a passion, and they usually don't make it very long. So find your purpose, find your passion. Like if it's a foundation and you want to do good for the world, do that, but go all in on it. Yeah. And I want to bring this, to this next question is, what's next for you? Because I see you at all the events. I know you're back in the financial, but what is your burning desire right now for the next 10, 20 years for Garrett?
Yeah, I want to help change families' financial future and their destiny by creating lasting legacies. And so I really want to help new money people, meaning people that didn't inherit yet, their first generation entrepreneurs. Because I know I made a lot of new money mistakes, doing this for 27 years. And I look back, I'm like, man, there's just a lot of things I learned from the School of Hard Knocks that it would be great if I could help people to avoid some of those mistakes. So I created a program called Multiplier. I know how you're Money Multiplier. My program's Multiplier. We're so friggin' aligned. When it was time to do this forward for the book, it was easy. But I'm teaching every week on either make more money, keep your money, grow yourself. And then I just, we help people get their financial house in order, create financial independence where they have cash flow coming in from their assets to cover their expenses. And then ultimately, build this life they don't want to retire from. Build a life that's just rich along the way and that they enjoy the process and love their life. And so I want to get just tens of thousands of people in that community, because the more powerful of people in the community, the more valuable the community becomes. And then I'm licensing my content to other financial people like you. There's not a lot of people like you. So when I say like you, I mean, I'm licensing my people that align with my values and that I could be doing stuff I'm doing like with you here today. We have an amazing audience. You set me up very well. You're a product of the product. And that, I'm inspired by you and everything that you're doing and the reach that you have. So I want to just get this where we flip an inverse that 90% of insurance is sold is either a term and whole life combo or whole life, or it's, we just inverse what's going on with IUL. And I feel like licensing my content is going to be the way to get there, because as you've seen, Rockefellers is a great way to start the conversation around legacy and death benefit and the family constitution. And we're not having to compete against IUL, which one illustrates better. We're like, we want this around no matter what. This is the plan. And so the more we can get that in great people's hands like you, the megaphone just grows. And so if I could be of influence to influencers like you, I'm going to do this till I die, because to get 1 million people to have a lasting legacy, I think that's going to take collaboration, and I don't have all the answers yet. I'm just in the game and willing to play it.
Man, I love that. And it's same with us. I mean, our goal is just to solve people's problems. We didn't put a number to it, but basically just every single week, we just keep doing the same thing consistently and persistently. Steven, you still on with us? Maybe you just shut your camera off.
What's up? Yeah, we had it where you guys were side by side, so we wanted to go off camera because it looked really good. But
oh yeah, that was great. But I with what he just said, where he, that's his desire, is to really go out and just help people. We've got an event coming up. I think it's short 2 weeks away, and it is a deep dive, a 2-day deep dive. Do you want to just talk about that for a second? Because I know a lot of folks here, when they're done. And Garrett, I can't remember. Are you joining us for the IBC intensive?
I don't know. Am I?
thought you were, but let me double check on that. I don't
When
want
is that? When is it?
September 12th and 13th, right, Stephen?
It is. And we can see Garrett if you're available. I'm not sure. We have a full agenda though. We have a bunch of speakers, and it's really the weekend's really gonna be very practical, personal, and powerful. And it's about shifting how you see money and then showing you how to actually put it into the infinite banking, into your life and how to put it into actual practice. So we're not gonna be doing like the technical side of like policy designs and splits and things like that. It's going to be very practical and like real world applications. So it's 2 full days though, September 12th and 13th, and it's $47 for the 2 days. And I put the link over in the chat box. Going to be a super powerful 2 days though.
Nice. Sounds like an awesome 2 days. I'll support you from a distance. High five, you guys. Glad that you're doing it.
Absolutely.
Awesome. Yeah, no. So with that, as we kind of get to the end, Stephen, are there any questions that we need to get answered with Garrett?
Craig, I know you had marked on here. Were these relevant for Garrett, or were these things you wanted to hit?
I think they're good just to bring to the forefront. I think Garrett can certainly answer some of these questions. And Chris, you can chime in as well.
All right.
Okay, cool. So they're just asking, what's the benefit of having my trust own my policies as opposed to simply having my trust as beneficiary of my policies?
Great question.
Yeah, so when it's a revocable trust, just having the trust be the beneficiary is suffice. Having a domestic asset protection trust own the policy could keep it out of your estate. So it's only the irrevocable where it would make sense to potentially have the trust own the policy versus just be the beneficiary.
Easy enough. And then Aaron was asking, he said, love both Chris and Garrett's books. My wife and I have trusts and IBC set up. How do we set up a family trust that passes the future generations, doesn't end with our passing? Maybe a modification of our existing trust to make the trust all our family IBC's beneficiary perpetually for future generations.
Chris, do you want to answer that one? Or?
Sorry, I'm just hitting a question here.
I mean, I don't know if you guys offer that service to help people get their trust set up.
We work with people that set the trusts up. That's not our forte. I mean, I talk about it a lot, but like a lot of what I do, Garrett, is what you do. I speak on things that I do in my own life, things that I've learned through the trials and tribulations I've had to go through. So like anything I can teach on trusts are twofold. Number one, how I did what I, explained in that video, but you can just watch that video and then, find somebody in your local area that's, estate planning attorneys or somebody that specializes in trust. Be careful with the shops that are slinging trusts out there all over. We do have people we work with, like Brent Carlson, who's near and dear to us. He helps people set up the trust. But when it comes down to that, the second thing I can teach is what not to do. I guess I'll air my dirty laundry. I got caught up in the glitz and glam of this. They called it the Rockefeller thing. It was like a waterfall trust structure that was set up, but it was solely for tax. Really, I hate to say this, but tax evasion is really what it was at the end of it. But they called it just tax planning, and you set the trust up solely to save money on tax, own nothing, control everything, and it was this whole thing. And I spent a lot of money setting this trust structure up. And after a year of doing this, some things just didn't seem right. I tend to like to think logically, and I'm not a tax attorney, but I know taxes, and just some things they were recommending just didn't seem to pencil. So first thing I did is I had an accountant review all my tax returns. They did. Not a good report. I hired another accounting firm to review the returns. Not a good report. Then I hired a tax attorney to review the structure. Not a good report. Then I had to unwind this entire structure. So you mentioned irrevocable trust. These were all irrevocable trusts, okay? And I had to unwind them all. You want to talk about a hard knock learning? You unwind an irrevocable trust. You learn about excise taxes. You learn about all these different things. I got really lucky because I fell within a 12-month exclusion rule that I was able to exit some. I had my primary house inside of a trust that the beneficiary was my private foundation. Wasn't told that the trust owning my house made it so we were technically self-dealing and living in the house. Yep. Secondarily, if I died, I wasn't told that the house was now owned by the foundation. My family has to move out. How many of you would love getting told that, but you weren't told that when you were sold it? You were told, oh, this is going to allow you to put your pool and do all your stuff on your house, and you can do it all with tax-free dollars. That sounded great. Too good. The unwinding of this entire thing cost me 2 years of 7-figure tax bills. So just let that sink in, folks. Plus about $150,000 in accounting and tax attorney fees. That was my learning lesson. You got a professor and you called that one attorney that wrote that white paper. I literally had to pay the piper to learn the hardest way. And then now I just do it the right way. And folks, like, I hope none of you ever have to do that. So when I teach trust, anything about trust, I'm going to only be able to teach you from what I've learned personally. I'm not a trust expert. I don't claim to be one, but we work with really smart people that are. So that would be a really long answer for a short question.
Yeah, I mean, it comes down to what I taught earlier. I'm not an attorney, but you got to find out, like, do you need a revocable or irrevocable? It's depending on how much wealth and where you're at, and the revocable can become irrevocable over time. You could always, you could convert it, but you don't want to do an irrevocable when it's unnecessary, because you learn about decanting a trust, which is a huge pain. Start with the basics that I mentioned: the living trust, the pour over will, the powers of attorney, and medical directives. That's the basic package. Get with these guys; they'll connect you to the right attorney that can help you get that done. And that's the key. Just got to have the right attorney.
All right, cool. Looks like we got one last question for you, Garrett. Appreciate your time today. This has been awesome. Yeah. But this person asked, I heard you say, Garrett, I heard you say you used to have a scarcity mindset. How did you overcome this?
Well, I've done a lot of work. I grew up in a family that my great-grandfather left Italy because he was being swindled and couldn't put food on the table, and gets to America in 1913, he wanted to be a coal miner, and there's a coal mining explosion. So he lives in a tent for 7 years and doesn't bring over his wife, who was pregnant when he left, and he meets his daughter when she's 7 years old. So we had handed down to us, and the other part of my family is Norwegian and Irish, so you have the Irish famine. So we had just, like, at a cellular level, being introduced to scarcity. Hold on to what you got. Be careful, like all this kind of stuff. And so it started for me when I just started going up to people from age 20 to 23 and just said, hey, you're successful. I'd love to interview you. I'd love to talk to you. And I just got introduced by people in the financial space to things like Landmark Education. I went through an ontological process there, or a strategic coach, and I started being around other more abundant people. Or I remember when I was first winning my first MDRT award, I'm like feeling really proud about it. And, that's for life insurance sales. And I'm like a rookie of the year kind of dude. And this woman comes up to me and she's like, that's awesome. I'm so happy for you. I can't wait till you get to the next level, the top of the table, because you'll see people view money differently. And I was like, what do you mean view money differently? And she had sold life insurance to Robert Kiyosaki. So I highly respected her, and I was just willing to dive in. And she starts asking me questions and I'm answering them. And then she just says to me, I wonder what it's like living in the financial prison you built for your wife. And I was like, oh, damn, I'm an a-hole. Like, I saw it, that I was in scarcity. It was all about what we could reduce, and nobody shrinks their way to wealth. But I was in that mindset because of my grandfathers and my family, my dad being a coal miner. And so I had to heal from that. So I did everything from, basically emotional freedom technique. I went to, just being around great people. I've done somatic therapy. Like, I've done the work to release the thing that was gripping me. And I've just been around people. And so when scarcity comes up, I'll literally pull this out, and I'll actually write and deal with the emotions. I had a coaching call with a mentor before this. So I'm constantly like dealing with whatever's holding me back so I can continue to expand my mind. So it's who I spend the time with, that I spend money on myself, and that I'm never looking at this as a complete work. I'm looking at it as a work in progress that allows me to think bigger and expand my vision to be of greater service and more impact and enjoy my life along the way. So it's a way that it's a lifestyle to invest in yourself and the people around you. And if you do that, you can overcome those scarcity mindsets. The biggest way that you'll do it is when you spend money on yourself, you tell yourself you're worth it. And it helps push scarcity out of your life, because you go, no, I'm going to do this. And then you get committed to the things that you do. I saw Chris speak at the same event I spoke at. I think we were some of the higher rated speakers there. And I was like, dude, you're phenomenal. You're like, yeah, when you first saw me, I was at one level and I just invested heavily, and I've done the work. And I'm like, and I could see it. It's paid off. I knew that success left that clue that he must have done a lot to get to that point. And so sometimes we just look and we're like, oh, someone's just born that way. No, man, they're dedicated. They're committed. They're willing to do the work. They're willing to go through the process, and they're willing to get to the other side because they're honest, open, and committed. Those are the three things: honest, open, and committed. If you can be that, you can heal your scarcity mindset.
It's interesting, Garrett. You just got me thinking, to when I first heard you speak. Dana Point, California, at Secret Knock. Me and my wife spent $5,000 we didn't have to be there. We sat front row. Garrett gets up on stage, talks all about what you just heard. I was a financial advisor. I listened to it just like googly-eyed. I was the student at that time, okay? I was just soaking it in. It was the very first exposure I ever had to IBC, to all of this stuff. After that event, I began working consistently and persistently at it, all the way up to where we're at now, 2025. It's a long time, folks. Things don't happen overnight. Garrett didn't happen overnight. I didn't happen overnight, and you won't happen overnight. With that being said, Garrett, I want to make sure that we're observant of your time in your next webinar.
Thanks,
Thank
man.
you so very much.
My pleasure to be on this. Thanks for having me, and thanks for the work that you're doing out there. Take care, everyone. Thanks for the kind comments. I was reading them over here on the side computer. Take care.
Awesome, Garrett. Thanks. Folks, I want to kind of wrap this webinar up with just a few things. First off, we want to make sure you all have an opportunity to get What Would the Rockefellers Do? This book that Hannah Kessler and myself, obviously, we wrote the foreword to it. We licensed it from Garrett, and we want all of you to have it. I don't know if the little tech issue is done, but please use that link. Get yourself either the ebook or the hard copy. If you get the hard copy, you just pay the shipping. You get the Legacy Builder course. That also comes along with it. But, there's another thing that I've been doing a lot, and I want to just kind of finish on this. Garrett talked about working on yourself, mentors, investing in yourself. We help thousands of people, folks. I think a lot of you know this, but some of you are brand new. I mean, we have thousands and thousands and thousands and thousands of clients. We help hundreds every single week. But the one thing I think that all of you need to understand is this has not been easy. We're teaching a concept that is literally very simple at its core, but it forces you to change your mindset around money. And a lot of people just have a really difficult time, and I get it. However old you are, 30, 40, 50, 60 years old, you got 60 years of conditioning about how money works. And all of a sudden, like, you show up to a webinar like this, you read Garrett's book, you read my books, and all of a sudden it just flips it. And it makes you start really it opens a door. Now, the next thing that you all have to do is decide, are you going to walk in that door? Are you going to go down that path to learn more? And some people go a certain distance, others go the full distance, like Tess, who's never missed one of these. But a lot of people stop 3 feet from goal. And Greg Reed wrote a book, 3 Feet from Gold, that all of you should read. I'm not going to tell a story from that, but I am going to tell a story from Earl Nightingale. And I believe Napoleon Hill talks about this. And it's about this professor who, he got this burning desire to help underprivileged children find a way to go to school. Well, he needed to raise millions of dollars to open this school, this college, where underprivileged children could afford to go get a formal education. This is a long time ago. So he went out there and he did the most powerful thing anyone can do. He went out and he gave a speech called Acres of Diamonds. And he did this speech hundreds and hundreds and hundreds of times on his own nickel. And every time he did this speech, it was to raise money for this foundation, which was going to build this college, which is now open, okay? But let me talk to you about the acres of diamond, because all of you are sitting in the middle of an acre of diamonds. You just don't know it. So the story goes like this, and I'm going to kind of butcher it, but there was a farmer who had this farm and had a brook that ran through it, and he farmed the land, but he started hearing about these people over in Africa who were finding diamonds and becoming millionaires. So one day he made a drastic decision to sell his farm, which he did. He sold his farm, and he took the money and he went over to Africa, an area he did not understand. He didn't know the diamond business, but he went over there to effectively invest in something he did not know, like, and understand, but he did it on a hope. And years went by. He's searching for diamonds, never found them. As the story tells, he was broke, and he eventually ended his life by jumping off a bridge. Well, let's come back to that farm. The person who bought that farm one day was out doing what he does on his land, farming it, and he crossed the brook and he saw a strange looking stone. And it just had a weird shimmer in the sunlight. So he grabbed the stone and he put it on his mantle. Well, one day he had a gentleman from the town over, and the gentleman noticed the stone and looked at it and said, do you know what that is? And the farmer said, it's just some stone I found. I just thought it was pretty. I found it out in our brook. Well, that person took that stone in, said, hey, can I have this look? Can I look at this and take this in and have this tested? Lo and behold, that stone was a diamond. You see, that man who sold the farm was sitting on a farm with literally the largest diamond mine in history. You can look this up. It's called Acres of Diamonds. And the man that bought the farm was literally sitting in an acre of diamonds, but the man who sold it died chasing his dream or his goal of finding diamonds when they were right under his feet the entire time. See, sometimes what you're looking for is right under your feet, is right in front of your nose. But when you're not searching for it, when you're not focused on that one thing, then you don't know, you're never going to find it. And too many people are always on to the next thing and the next thing and the next thing and the next thing. And oh, this shiny object, that shiny object. The best advice I could give all of you is just focus on the things you know, like, and understand. And if there's something you're interested in, learn about it. If you want to learn about how to properly structure your family constitution, how to structure your trust to best serve your needs, which are different than mine, that are different than Garrett's, that are different than Stephen's, then learn. Spend the time, hire the mentors, hire the experts, get educated on what it is you're doing, because otherwise you might be sitting on acres of diamonds that you let go because you're chasing the next big thing. I butchered that story, but you know what? It still works. You understand what I'm trying to say. So I really appreciate all of you joining us. I thought that was really special. I mean, Garrett's just a special kind of human being. And it was amazing that he gave us the time. Sorry, I kind of thought he was coming to the event that we're doing. I know we'd talked about it, got a little over my skis on that one, but that's okay. So we're going to be teaching you some amazing things at this 2-day IBC training. So please join us September 12th and 13th, you know, because that too is exactly what you need. You need to invest in yourself. So some of you might be saying, well, it's $47. You know, we were going to do this training for free. This event you're on today is free, but because it's free, a lot of people will get value from it, but they'll never do anything with it because you don't value things that are free. So the vault, we could give that away for free, but we're not going to because nobody values it. The 2-day event that we're doing, we could have gave that away for free, but we don't, because we know that if you invest $47 into yourself, you are your best investment, you will benefit, you will value it, you will take more from it, and you will get more out of it. It's a simple thing. You value what you put your hard-earned dollars towards. So put your hard-earned dollars toward this 2-day event. And I promise you, you will not be disappointed. So with that being said, folks, I really appreciate all of you. I hope you got a lot out of today. I'm glad the team, Stephen and Craig, you know, were hard. I saw them. They were just pounding away at your questions. Hopefully you got all your questions answered. And also, if any of you want, tonight, we're going to be doing another mini training. Now, if you already bought your tickets for the 2-day, you don't need to come tonight. But if you didn't buy tickets for the 2-day and you're thinking, well, I don't know, let me know more about it, join us tonight. We're going to be doing another training, 6:30 to 7:30. It's totally free. And it's going to be for people to learn about what we're doing at that 2-day training. We're going to give you highlights. And then from there, if you're not convinced that that can be an event that could seriously change your financial future, well then, hey, at least you got some free education out of it, right? And we part as friends and everybody's happy. All right. Well, with that, we are at time. So Stephen, Craig, anything you guys want to say before we leave?
No, this has been awesome just listening to Garrett and you discuss. I mean, it just beautiful amount of time here. And then Steve and I have been working the fingers back here answering questions. So appreciate you all being here today. Stephen, to you.
Yeah, no, good stuff. Just to recap, if you follow the link for the book, it's a special offer where you'll receive the ebook for free. And then if you want to order the physical copy of the book, you just pay shipping, and that includes the audio book as well, which I was listening to the audio book on Audible over the weekend, and it's really good. Garrett is the one narrating it, which is, I always love when the author of the book narrates the audio as well. It's always much better that way. So as you heard, Garrett today has got a talent for speaking and telling stories. So the book is very entertaining. So highly recommend picking up the physical copy with that audio version as well. And then, like Chris said, get your ticket for next week. I thought it was 2 weeks away. It's not even a week and a half, 9 days away. The start of the 2-day 2025 IBC training. It's the one and only virtual training we did this year. So we're putting everything into it, and it's going to be awesome. So looking forward to seeing everyone next Friday and Saturday for the 2-day virtual. And I'll put the link one more time for that. But appreciate everyone being here. We'll see you guys soon.
All right, and we're going to answer some questions after, so stick around if you got some Q&As over there, you have additional questions, but go out there, folks, and create a generational financial legacy. Create a legacy that has value, resources, and opportunities for our future generations. Because listen, the way I look at it is we're the best shot they got. So be the best shot your future generations have, and make sure that your name is remembered generation after generation after generation. That's what I call building a legacy. With that being said, thanks for joining us for this wealth webinar. We'll see you on the next one.